Good afternoon, friends. It is 12 p.m. CST here at Dallas. As you know, every Thursday at 12 p.m. CST, we are here on YouTube, Instagram, Facebook, and LinkedIn with a new topic for you. I am Abhishek Gandhi, CPA and Tax Director at AG FinTax. With over 20 years of experience in US taxation, tax planning, my team and I put a lot of efforts into researching and bringing this information to you in a simple, easy to understand format. Please subscribe to our channel and encourage your friends and family to take advantage of this opportunity. Today, we are diving into a very important topic, that is a smart ways to lower your social security and Medicare tax burden. We all pay Medicare taxes and social security on our income, right? So many times we plan about many other things, but this one important area we don't focus, thinking that this is not avoidable. It's not avoidable for sure, but that can be, we can plan. So I will give you an overview of FICA taxes. When I heard FICA for the first time, it sounded to me like a name of virus. I mean, FICA. Anyway, uh, for 2024, the social security tax ceiling has increased to 168,600. This means that high earners will pay a maximum social security tax for 20,906. And this isn't one time thing. The Social Security Administration projects that this ceiling will continue to rise annually, possibly reaching 242,700 or more by 2033. In addition to social security taxes, the government also imposes a 2.9% Medicare tax on all wages and self employment income, with an additional 0.9% Medicare surtax for high income earners. Now, this taxes can add up pretty quickly, but don't worry. Today, I'm going to share with you some strategies that can help you reduce your Social Security and Medicare taxes, also known as FICA taxes. Let's get started. So, first that comes in my mind is HSA. We know it as a health saving account. So when we contribute to health saving account is a smart way to lower your tax burden. And while this strategy doesn't directly reduce your FICA taxes, it does lower your taxable income, which can have an indirect impact. Let me explain. So, the way it works is we can contribute to an HSA, and that's a pre-tax HSA, meaning that the money you put into the account is not subject to income taxes. And that's not all. HSA offers a triple tax advantage. First, you contribute your contribution are tax deductible. Second, the earnings on your HSA grow tax free. And third, withdrawal for qualified medical expenses are also tax free. Let me give you one quick example. Imagine you are a high earner. What I mean is you have a high income, right? And you're contributing maximum 7,750, whatever the maximum family contribute for 2024. So by doing so, you are reducing your taxable income by that amount, which not only lowers your income tax liability but also reduce your overall financial burden. While it doesn't directly reduce your FICA taxes, it certainly lightens the load on your overall tax liability. So are you all are with me? So this contribution will help reducing FICA, and we can lower your social security taxes. Second thing that I would suggest is you can set up an small corporation. We all have heard about small corporation, as corporation. Yes, you got it. So if you own a business, another effective strategy is to set up as corporation. By electing to treat your business as a small corporation, you can significantly reduce your FICA tax liability. Here is the key though. As an S corporation owner, you can pay yourself a reasonable salary, which is subject to FICA taxes, and take additional income as a distribution, which is not subject to FICA taxes. So, this strategy can be particularly beneficial for those who have high earnings from their businesses. The savings can be substantial depending on the salary you set, the distributions you take, and imagine this scenario. Let me give you another scenario. So let's say you are making $200,000 annually, and I'm talking about income from your business. If you decide to pay yourself a salary of, say, $100,000, so now you will be paying FICA taxes on that $100,000. But the remaining $100,000 you can take as a distribution. And this is not subject to FICA taxes. So by doing this, you have effectively reduced the portion of your income that's subject to Social Security and Medicare taxes. Of course, it's important to make sure that the salary you pay to yourself is reasonable in the eyes of IRS. But this can be very effective saving strategy, right? We will talk about reasonable salary and all one day, but because that is a very relative term. So and it depends from person to person, depends on each individual, right? So third one that I would suggest is you can utilize tax deferred retirement accounts. This is another way to lower your tax burden, is by contributing to tax deferred retirement accounts such as 401k or a traditional IRA. While contribution to this account don't directly reduce your FICA taxes, they do lower your taxable income, which in turn reduces your overall income tax liability. So this is all indirect way of reducing your taxable income. As we all know that once the taxable income will go down, your overall income, your tax liability will also go down. Let me break it down for you a little bit so that it will be easy for you to understand. So if you're contributing to 401k and those contributions are made pre-tax, correct? You contribute that before anything you pay to Uncle Sam. Now they reduce your taxable income for the year. This not only helps you to save retirement but also reduces the amount of income that's subject to income taxes. By lowering your overall taxable income, you are effectively lowering the base on which FICA taxes are calculated. So this is indirect way of saving taxes. This is great strategy for anyone looking to save for future while also managing their tax burden in the present. One more, that you can maximize employer benefit. So if you own a business, right? So how you can maximize your employer benefit? Let's talk about it a little bit. Many employers offer benefits that can reduce your taxable income, such as flexible spending account, like FSA. You must have heard like FSA. FSA stands for flexible spending accounts, or transportation reimbursement plans. These benefits are often offered pre-tax, meaning they reduce your taxable income again. Are you with me? So, in turns, it will lower your FICA tax basis. Again, example. Let's see the example. Today I have brought so many examples for you, so that will really explain everything. You will understand. So we will talk with the numbers. So let's say your employer offers an FSA where you can contribute up to $3,050 for medical expenses. If you take full advantage of this benefit, then you are reducing your taxable income by $3,050, which means that you are also lowering the amount of wages subject to FICA taxes. By maximizing this employer benefits, you can effectively reduce your overall tax burden while taking advantage of valuable benefits that improve your quality of life. Are you guys with me? So again, this is again a very powerful strategy. One more strategy that I can bring it to your notice, and that is defer income. This strategy to consider is if you have a flexibility in how and when you can receive your income. See, this strategy only works when you have a flexibility that when you can earn this, right? It is not for people who are a fixed salary job. So, so you might consider deferring it now or later year. Then only you can use it. This can be particularly effective if you are close to retirement or expect to be in a lower tax bracket in the future. Again, consider this scenario. Let's say you are nearing retirement and have an option to defer a year end bonus until the following year. By doing so, you could lower your taxable income for the current year, reducing your FICA tax liability in the short term. So, this strategy can be very useful in managing your overall tax burden, especially as you approach retirement and want to minimize taxes during those final working years. Okay, so that's again very good. That takes planning, of course, but it's a very good strategy. Then you can also take advantage of fringe benefits. Employers often provide non cash fringe benefits such as health insurance, adoption assistance, or education assistance, which are generally not subject to FICA tax. They if they give you some assistance for the education or something, they cannot charge you, they cannot tax you for FICA. So this benefits provide significant value without increasing your FICA tax liability. So let's talk a little bit about this benefits. Okay, for example, if your employer offers health insurance, the value of that benefit is not subject to FICA tax, as I just said, right? So this is a great way of receiving valuable benefit without without adding your tax burden. By maximizing use of this fringe benefits, you can enjoy additional compensation without the accompanying tax hit. It's a win-win situation for you and your employer, right? So One more thing that I can think of is use salary reduction agreement. Now this is not very normal, but some employers offer salary reduction agreements where you can allocate a portion of your salary benefits such as 401k or an HSA or before FICA tax are applied. So this approach reduces your taxable income, which in turn lowers the amount subject to social security and Medicare taxes. Here is, let's see here is how it works. I'm thinking about giving you one more example. Okay, so let's say you're earning $100,000 a year, and you decide to contribute $19,000 to your 401k. By doing so, you have reduced your taxable income to 81,000. Not only does this lower your income tax today, but it will also reduce your FICA tax basis, thereby lowering your overall tax liability. So, this is how it works. This is a powerful strategy that allows you to save for retirement while simultaneously reducing your tax burden. So these are the strategies that those are very very important. Now another thing that I can think of is a consider timing of retirement. Timing of your retirement can also have a significant impact on your social security tax burden. If you are approaching social security wage based limit, consider delaying retirement until the new year. By doing so, you may avoid additional social security taxes that could be incurred if you continue working into the new tax year. So let me explain this a little bit. You are close to the social security wages based on based on the limit in December. So whatever limit is there till December, you earn that money, you complete that money. You might want to consider postponing your retirement until January. This could help you avoid paying extra social security taxes on your final paycheck of the year. So in a prior year until December, you will not be paying your social security amount, which because now you are retiring in January. So by carefully timing your retirement, you can minimize your tax burden and keep more of your hard-earned money in your pocket. Now, you have to understand how the additional Medicare tax works. Okay, because that is also very important with associated with this point. Let's talk about the additional Medicare tax. This tax applies to high earners again. So with a threshold of 200,000 for single filers and 250,000 for married married couples who file jointly. So the additional Medicare tax is 0.9% on earnings above on this earnings. This threshold, it's in addition to the standard Medicare taxes, and that rate is 1.45%. So here is something to think about for you. If you are a high earner and expect your income to exceed this threshold, right? 200 for single and 250 for married filing jointly. Timing your income and retirement can help you manage your exposure to the additional Medicare tax. So for example, if you retire in mid-year, your total income might stay below the threshold, helping you avoid the additional 0.9% Medicare surtax. This is an important consideration for anyone approaching this income level. So, as proper planning can save your money in the long run. That's the idea here. So, in conclusion, what did we talk about? Let's summarize this. Okay. In summary, there are many smart strategies that you can use to lower your social security and Medicare tax burden, from contributing to HSA, setting up small corporation, to utilizing tax deferred retirement accounts, maximizing employer benefit. This all approaches can help you manage your tax liability effectively. Remember, the strategies should be considered within the broader context of your financial plan. So, it is wise to consult with a tax advisor to ensure they align with your long term goals. Thank you. Thank you for joining. Thank you for joining today. And if you found this information helpful, please subscribe to our channel and share this video with others who could benefit from our tips. We will be back next week again, next Thursday at 12 p.m. CST with another topic that will help you to navigate complex world of taxes and finance. Until then, take care and keep planning smartly for your future. If you have any questions, let's open the question answer session now. I don't see any questions yet. Let's wait for another 10 seconds and see. Oh, okay. Admin, okay, no question. All right, guys, then, I will close today's discussion. If you have any other question, anything that come in your head later, feel free to ask us your questions, and I will be more than happy to answer all your questions. Thank you so much. Thank Have a great day.